on this morning's Ag Issues program. A pleasure, as always, to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. And Roger, it sounds like, first, good morning, but sounds like you're under one of those showers too.
Good morning, Greg. Yes, I'm very hard with lots of thunder and lightning, so I hope this works this morning by phone.
Yeah, exactly. All right, let's get to it. And one of the things we want to talk about, and I'm sure people have heard about it, the marathon session in the U.S. Senate over the weekend has been termed the Inflation Reduction Act of 2022, and there are a lot of things to look at. And content-wise, I think, is probably the biggest thing that trying to get those last two votes of the Democrats, holdout Democrats, West Virginia Senator Joe Manchin and Arizona Senator Kyrsten Sinema, of what was in it, now what is not in it, but still what remains in this bill.
Yeah, and that was changing throughout. And in fact, I got my hands finally on the last and final version that was voted on early this morning, and have had about the last hour and a half to kind of go through that. I've been monitoring it all the way along. I did a blog article a couple of weeks ago on this, and that's the commentary in there concerning the tax provisions is totally outdated, because those things, one of them, I didn't get included in the final bill, thankfully. But this is probably one of the most misnamed pieces of legislation ever. This is a rescinding inflation increasing bill, and I base that on what the Joint Committee on Taxation's report is that's out early this morning. It came out about 3 hours after the Congress got the final version done, and I've got that report in front of me, and that's what I want to work from. The JCT is a nonpartisan tax analysis committee of the Congress, and they look at all of this legislation, they score it, and they break it down. And there are 9 titles in this provision, in this bill, that have tax provisions in them. And I'm sure people have heard the news about some of these, but let me give some more detail on these. One is Irs Funding. And I'll get to the rates and the distribution factor in just a moment, because the president's supposed promise during the campaign that no one making under $400,000 would pay a penny more in tax. Well, that was blown to smithereens a long time ago with inflation. But I think what he was referring to is tax rates. Now, the tax rates matter is also obliterated, because this increases rates on everyone, including now people making less than $10,000 per year. And again, this is all based on the Joint Committee on Taxation analysis. One of the things we want to look at is Irs Funding. This, I've never seen anything like this. This is increasing Irs funding by $80 billion, that's with a B, dollars. And the argument is that we're going to go after the high-end people, going to bring in more money, and that's going to reduce the deficit. That's the argument. But according to the Joint Committee on Taxation, the brunt of any new revenue from hiring this army of IRS auditors will overwhelmingly hit low and middle income earners. And those are most impacted by inflation that's in the economy right now. Also, in addition to the Joint Committee on Taxation, the Congressional Budget Office scores that $80 billion for mandatory IRS spending only, and gives phantom credit, I'd put it that way, for potential enforcement revenue that might be generated in future baselines. So it's all speculative. This is how the Joint Committee on Taxation breaks that $80 billion down. $45.6 billion is earmarked for enforcement purposes, $25.3 billion for operations support, $4.8 billion for business systems modernization, and only $3.2 billion for taxpayer services. And I deal with tax practitioners all over the country, and the frustration that they have with IRS, the service aspect of the IRS is woefully inadequate. Well, that's the least funded part of this. But how that $45.6 billion for enforcement purposes will be used to address non-compliance issues is the big issue. And based on IRS data, out of all the revenue projected to be raised or reported income, this is the key for people to hone in on. This is based on the JCT's analysis of the IRS's own data. 78 to 90% of the additional revenue derived from increased IRS audit activity, 78 to 90% will come from those making less than $200,000. About 65 to 78% is projected to come from people making less than $100,000, and 40 to 57% will come from taxpayers making $50,000 or less. What are they looking at? They're looking at Schedule C income, that's your business income, and that would include farmers, although farmers are separately on a Schedule F. But they're looking at business income, and specifically with respect to non-farm businesses, 20 or 52% would be, the revenue would be coming 52% looking at Schedule C's of people or businesses that have $0 to $50,000 reported on a Schedule C. 21%, so get to a total of 73% would be 100,000 or less on a Schedule C. The other one is Schedule E income. So for a farmer, that would be your cash rental income. The bulk of that, again, 34%, the estimated tax assessments related to underreporting, 34% would come from returns of AGI reporting less than $50,000, and 25% would be 50 to 100,000. So that's 59% of your audit activity for small businesses and rental activities coming from people making less than $100,000. That's huge, and that's incredibly important. And that's one way Congress hides this. They say, well, we didn't increase rates. No, you just funded by $80 billion an increase in funding for IRS to target audit activity on middle to lower income people. And I'm not sure the public recognizes that yet.
And also the fact that if the onus, in this case, going on to small businesses, who has struggled the most here in the last 2.5 years since March of 2020, when everything shut down, it's the small business, of course.
Right. Yeah, and that's where they do that. Only about 9% of your audit activity trying to focus on underreporting would come from those businesses and Schedule E income reporters that returns that have $500,000 or more that's reported on the return. The income is with the small businesses, and that's what they're going to try to rake. They're going to try to go out and cast a big net pretty wide over a lot of small businesses. And you're right; those are the ones that were hurt the most over the past couple of years. The other thing, Greg, that's in here is this, and I'm sure most people don't understand this at all. And this is another one of these tricks. Congress will do this; they can get away with it. They can go to voters because voters don't understand this at all. You've got to be a pretty good tax practitioner to understand this. And believe me, out in Colorado last week and in the state of Washington, and this book minimum tax issue that's in this bill came up at both seminars, and practitioners wondering, is Congress really doing this? The answer is yes. This is a book minimum tax, and the argument is, well, it doesn't raise taxes. It closes loopholes by making large companies pay at least a 15% minimum tax. No, that's not right. A book minimum tax is the Joint Committee on Taxation has scored this as a $313 billion tax increase, with half of that increase falling on manufacturers. That's what the Joint Committee on Taxation has said. The Finance Committee has also said that. So we've got a couple of basically nonpartisan groups that have said the same thing. The book minimum tax, this 15%, if we want to call it a corporate AMT, does not close any loopholes. You see, book minimum tax is based on financial statement or book income. That's different than that's a different set of rules. Let me phrase it this way. That's established for an entirely different purpose than taxable income is. And so claims that a book minimum tax closes loopholes simply ignores the fact that the provisions resulting in different book and tax treatment were specifically enacted by Congress for sound policy reasons. So, for example, when a farmer goes out and buys a tractor, buys a combine, makes some type of capital investment, the tax treatment of that differs for book and tax purposes. And that's in part to encourage farms and other businesses to invest in capital assets in the United States. Well, this book minimum tax is based on book income, or the income reported by companies on their financial statements. Companies, and including farmers, you calculate your tax liability based on the tax accounting rules that are set forth in the Internal Revenue Code. Book accounting is typically based on general accepted accounting principles, which we call GAAP, and there's no uniform financial accounting standard. And the accounting rules are set by Financial Accounting Standard Board, but the Internal Revenue Code is set by Congress. And so what you've got here now is the Congress getting into accounting standards. And the key difference on this, and this is really the point for people to think about here, the key difference between book and tax accounting is the treatment of a business's investable assets like machinery and equipment, tractors, combines, all types of farm equipment, grain storage facilities, those types of things. Well, when you buy those for book purposes, you write off the value of that capital asset in line with its decline in economic productivity. That's depreciation. For tax purposes, the cost of most of your capital assets, including machinery equipment, we can fully deduct that. We can take bonus depreciation when we buy it. We can take expense method depreciation and get an off-the-top depreciation allowance. Well, the book minimum tax will penalize companies that utilize the tax treatment related to those investments. And so it's going to diminish the ability and the tax benefit of those accelerated depreciation provisions, and it will end up encouraging manufacturers and others to invest elsewhere. Joint Committee on Taxation is now estimating that half of that $313 billion book minimum tax would fall on manufacturers, and that's going to target capital investments that encourage in a down economy. And in fact, the Joint Committee on Taxation says it will create a real GDP reduction of $68.45 billion when we've already had now 6 months of declining GDP, 218,000 fewer workers in the overall economy, and a labor income decrease of $17.11 billion. That's really one of the most harmful economic provisions. It's a tax-related provision in this bill, and you could pick somebody, Greg, a microphone and walk out on the street in Topeka or elsewhere in Kansas City or in Lawrence and ask people to explain book minimum tax to you, and I bet you less than 1 out of 100 random people would have any idea what you're talking about. But this is what Congress is doing here, and that is a major, major problem.
Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, is joining us and talking about the Inflation Reduction Act of 2022, which passed the U.S. Senate after a marathon session this weekend. And we've been talking about some of the particulars that are still contained in this bill. Also, a couple other things within that, Roger. There are Obamacare credits, too.
Yeah, there are separate provision in the bill. There are extending the credits for the various types of things that were in the bill. The premium assistance tax credit is one of those. So they've enhanced those, extended those. They've put more extenders in with respect to other types of credits. There's an entire title to the bill. Let me get you the title for it here. It's we have Part 2. Let me change that. Basically, 9 parts here that deal with either Obamacare credit extensions or other types of energy extensions on so-called renewable energy, and that's really what this bill is. It's raking in a lot of funds to provide incentives for further green type of energy. Part 1 is clean electricity, reducing carbon emissions title. Then you have clean fuels, then green energy and efficient incentive for individuals, clean vehicles, investment in clean energy, manufacturing and energy security, reinstatement of the Superfund tax. That's $11.7 billion by itself. the reinstatement of the Superfund tax. That's for cleanup of hazardous waste sites. Incentives for clean electricity and clean transportation, credit monetization and appropriation. And that has to do with energy, certain types of energy property. So there are all types of these provisions in there. You're right. Obamacare extension of certain credits is also included. Extension, and I would add expansion of those credits.
And you talked about some of those green energy credits that, they're also plugging as far as what contains in this bill. Some of them are just ones that are extended, but I understand there are some new ones as well.
Yeah, there are new ones that are in their existing credits that are set to expire, and those have been extended. But the ones that have been extended are incentives for biodiesel, renewable diesel, alternative fuels, second-generation biofuels, aviation fuel credits, clean hydrogen. Those get extended, and then you have some other extensions, but some new ones are included in there also. Advanced energy products, advanced manufacturing product credit. That one will sunset in 32. And actually, the sunset on these is about 10 years out on these new credits. They do that. That's a budgetary issue. Although I'm curious as to why Congress cares about budgetary issues anymore. But they set those for 10 years out. They have various other types of so-called clean energy credits that are included in the bill, too. Manchin did get some provisions in there for increased drilling on new areas where leases could be opened up. That's probably how they bought his vote to protect his constituents in West Virginia. But I think that's fool's gold for those people. On all of this, when you factor in those credits and everything about the entire bill, the Joint Committee on Taxation is saying that this is in next year alone, taxes will increase by $16.7 billion on taxpayers earning less than $200,000. So that's a major tax increase, and another $14.1 billion on taxpayers making between $200,000 and $500,000. But that big hit is on those making less than $200,000. And over the 10-year window of this bill, the average tax rate for nearly every single income category would increase. Now, it may be a slight increase, but Joint Committee on Taxation projects a rate increase, an effective rate increase for every single income category over the next 10 years as a result of this bill.
From the, I humorously asked this question, from what it was originally, what they had to take out for Manchin, what they had to take out for Sinema, I heard maybe a little over $400 billion was the final, I guess, amount that was in the bill versus originally what it was.
Yeah, I would say this could have been, as bad as this is from an economic standpoint and the way the Joint Committee on Taxation is looking at this, it could have been much worse. And that seems unbelievable to say that, but there was all kinds of stuff in there. I was worried that the net investment income tax, that 3.8% tax on passive income that was included in Obamacare, would have stayed in this and attached itself to business income. They took that out. They also took out that he carried in that Elizabeth Warren wanted, which is to basically cause a tax increase on hedge fund managers, and they removed that to get Sinema's vote, which was interesting. They also did not remove the cap on the state and local tax deductions, so that stays in place, and that was kind of a trade-off. There are a lot of Democrats that don't like that because they represent very high end states that have high property taxes, and so they wanted that limitation removed, but that stayed in. Interesting enough, but there were a lot of changes, and of course there were a lot of changes just the last 10 days, and it got to be difficult to figure out, all right, what's in, what's out, where are they going, and what's the vote trading. But it did pass last night on the vote of the vice president who broke the tie in the Senate. Now it goes to the House.
Yeah, I was just going to ask, is quote unquote, is this a formality that the House should have enough votes to pass this? Well,
one would think so. on this bill, the biggest struggle would have been in the Senate. I think it's probably a foregone conclusion that it'll pass the House. Now, you never know for sure, but yeah, I think this one probably is a done deal, only to have to be unwound by some future Congress after it's reconstituted this fall.
Yeah, exactly. All right. Roger, and I'm sure you will keep people up to date. They can keep up to date on this on your blog.
Yep, I'll be adding in some commentary on this. I leave for Denver later this afternoon. This will be one of the things I'll be addressing in Denver tomorrow.
Okay, sounds good. Roger, as always, appreciated. Thank you very much.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.